All right, the closing bell rang exactly 15 minutes ago. It is the end of the Thursday session, January 22nd.
Machines are quiet.
Finally quiet. But the numbers are locked in. Let's run the scoreboard. The S&P 500, it closed at 6,922. That's up 0.67%.
A solid green day.
And the NASDAQ composite finished higher too by 0.8%. Though, and this is the key detail, it trimmed some serious early gains. It was up over 1.1% at one point.
Right, and the real outperformer was the Dow.
The old guard.
Yeah.
The Dow Jones Industrial Average added nearly 500 points right into the close.
So it looks green on the screen. It feels like a rally. But I have to be the buzzkill right out of the gate.
Oh, here we go.
If you lift the hood on this thing, you've got a check engine light blinking. The indices paint a pretty picture, but the machinery is grinding its gears.
Okay, hold on. You're calling a near-record close a check engine situation. That feels a little counterintuitive.
I know.
We're knocking on the door of all-time highs again. Most people opening their brokerage accounts tonight are going to see green and feel great. So why are you seeing a warning light?
Because it wasn't a clean breakout. It was really a relief squeeze. To understand today's price action, you can't just look at the closing print. You have to get the narrative shift that happened overnight.
Two big catalysts.
Two massive catalysts collided head-on. First, the macro driver. The street is calling it the taco trade.
Taco, like the food.
TACO. It stands for Trump always chickens out.
That is blunt. But let's unpack that, because that's actual trading desk slang we're seeing in the notes today. It's not just a joke.
No, it's not a political statement. It's a market pricing mechanism. Think about the fear earlier this week.
Yeah, the Greenland dispute.
The market had priced in a full-blown trade war escalation over that. Traders were hedging, buying puts, expecting a breakdown in European relations. Then the White House backs off the tariffs.
The Greenland framework deal. So the tail risk just vanished.
Exactly. And when you remove a massive downside risk like that, the market doesn't just sit there. It reprices upwards instantly.
It's like holding a beach ball underwater and then letting it go.
That's the taco trade. The market bet on the administration blinking. They blinked, and risk assets rallied because that worst-case scenario was just taken off the table.
But that wasn't the only fuel for the fire. We had hard data this morning. Q4 GDP hit 4.3%.
A monster number.
I mean, 4.3% in this environment. That sounds more like a Ferrari engine to me, not a check engine light.
It's huge, and it explicitly confirms the no-landing scenario. We're not getting a hard landing. We're not even getting a soft landing. We are just flying. The economy isn't slowing. It's accelerating.
But there's the trap.
There is always a trap.
Yeah.
That GDP number came with the side dish that nobody wanted. Sticky core PCE data.
Which is exactly what the Fed is staring at right now.
And they are in a blackout period. They can't talk us down. They are watching this exact data in total silence.
So you got inflationary growth at 4.3% and sticky prices.
Which keeps the Fed's hands completely tied ahead of that January 28th meeting.
So let me get this straight. Investors today are buying the growth story from the GDP number, but they are terrified of what it means for rates next week.
Precisely.
Yeah.
And that's why you saw the NASDAQ trim those gains. The good news on growth is potentially bad news for rates.
Right.
If the economy is this hot, Powell can't cut. He might even have to sound hawkish. And that tension is why the engine is making a funny noise. We're speeding up, but the brakes might just slam on next Wednesday.
That tension really explains the rotation we saw on the leaderboard today. You said the Dow outperformed. We saw a really distinct shift out of pure software and tech and into what the notes are calling the real economy.
This is the physicalization of AI thesis playing out in real time. We've talked about this.
Mm-hmm.
Big money is looking at the screen and saying, okay, software multiples are stretched, but we need energy to run the data centers and we need utilities to power the grid.
So you sell the AI software and you buy the power plant.
You saw the Dow Industrials, defensive value like P&G, Amex, they all caught a serious bid. And look at what got sold. The semis were the ATM machine today. Traders were just taking profits.
De-risking ahead of earnings.
Absolutely. We have Intel tonight, but more importantly, it's the Mag 7 earnings next week. If you're a PM sitting on huge gains in semis, are you really going to bet the farm right before the Fed and Apple report?
No way.
No. You sell the high beta tech, you buy the boring Dow stocks, and you call it a day.
Okay, let's get into the internals, because this is where the story gets really interesting. You called this a relief squeeze. Did we actually get the volume to back that up?
We did, but with a major caveat. Total volume tracked about 12% above the 30-day average. Now, 12% is decent, it's actionable.
But it's not explosive.
Not explosive, this wasn't panic buying.
Not FOMO.
No, not at all. This was a very mechanical move to fill that futures gap on the S&P 500 from Monday. The algos were targeting 6,950, and we're just inching towards it. It's moderate conviction.
Okay, his volume is just tepid. What about breadth? Were the troops actually following the generals into battle?
That tells a slightly more bullish story, actually. The advanced decline ratio on the NYSE was a healthy 2.4 to 1.
So for every stock that went down, almost 2.5 went up.
Roughly, yeah. But here's the stat that really matters to me today. It's the RSP versus SPX spread.
The equal weight S&P versus the cap weighted. For anyone who doesn't watch this spread, explain why that specific metric matters so much today.
Well, because the S&P 500 can be a mirage. It's usually driven by just 3 or 4 massive companies, Microsoft, NVIDIA, Apple.
Right.
If they go up, the whole index goes up, even if the other 490 stocks are crashing. Today, the equal weight S&P 500 outperformed the headline index by 45 basis points. That's significant.
It means the rally was broad.
It means the soldiers actually joined the march. It wasn't just a rescue mission led by the generals. When the average stock outperforms the mega caps, that's usually a signal of a much healthier tape. It implies money isn't just leaving the market, it's rotating.
But you said the NASDAQ struggled. So we have this weird divergence where the average stock is doing okay, but the leaders, they look tired.
And that brings us to the divergence flag we have to plant right here, the new highs versus new lows index. The S&P is knocking on 6,900, near all-time highs. But fewer individual stocks are making new 52-week highs today than they were back in November.
It's a thinning tape.
Exactly. It's like a fortress. From the outside, the walls look just as high as they did in November. But inside those walls, you just have fewer soldiers standing at attention.
It's a classic late cycle divergence.
It is. It doesn't mean a crash is imminent. Markets can stay thin for a long, long time. But it does mean the foundation is getting a little shaky. The rally is getting harder to sustain without fresh capital.
One thing that was definitely not shaky today was the VIX. I mean, we saw an absolute collapse in volatility.
Eviscerated is the word the trading desk used. The VIX dropped from a high of 21 on Tuesday all the way down to 15.9 today. That is a 24% retreat in just 48 hours.
That's a massive move. Walk us through the mechanics there. Why does a drop in the VIX force stocks to go up?
It's called the vol crush.
Yeah.
So think about dealers, the big banks. When geopolitical tension is high, like with the tariff threat, they sell insurance, which is puts. When they sell puts, they are short volatility. To hedge themselves, they have to short the market futures.
So fear makes dealers short stocks to protect themselves.
Right. But when that tension disappears, when the Greenland tariff threat got pulled, all that fear premium just evaporated. The VIX crashes. Now all those dealers are overhedged.
They're short too much stock.
Way too much. They have to vomit back those hedges.
Which means buying stock.
Buying it aggressively. When you unwind a big VIX hedge, you are forced to buy the underlying equities. It creates this tailwind, the Vanna and Gamma effects.
Let's pause on Vanna. We hear quants throw that term around. In plain English, what is the Vanna effect doing to the market right now?
Vanna is just the rate at which a dealer's hedge changes as volatility changes. So when volatility drops like it did today, the dealer doesn't need to be a short anymore.
So they buy.
They buy. It acts like a magnet, pulling the market up. It's a purely mechanical bid. It doesn't care about earnings. It doesn't care about the Fed. It's just math resolving itself.
But it's always a but.
But, and this is crucial, a VIX at 16 is still above the 2025 lows of 13.5. We are not back to total complacency yet. It's a reset, for sure, but the market is still keeping one eye open.
Let's pivot to some specific names because we saw some wild moves that really highlight this environment. We talked about the check engine light, and I think GE Aerospace is the perfect example of that.
GE was the bearish reversal of the day. And frankly, it's a warning shot for the entire market. They reported Q4, they beat EPS estimates $1.57 versus the $1.44 expected.
Solid beat. Stock should go up.
It did. It popped to $320 intraday, but then they gave the guidance. They forecasted 2026 revenue growth at only 1%. The stock just fell off a cliff. Closed down 5.7% near $301.
So 1% growth does not justify that multiple.
Not even close. This is the lesson. In a neutral check engine market, you cannot have record valuations with mediocre guidance. The growth at any price crowd looked at that 1% number and just hit the eject button.
On the flip side of that coin, we saw the exact opposite happen with Intel.
Intel was the bullish reversal. It opened red, looked really ugly on earnings jitters, and then just ripped higher to close near $50.
Now, Intel has been a troubled story for a while. What's the thesis there? What drove that?
It's the government put. The market is pricing in the fact that the U.S. government now holds a direct stake in Intel. It effectively sets a technical floor under the stock.
It's too big to fail because the government is a shareholder.
Traders are betting the government won't let it fail. It's a safety net trade. You aren't buying Intel for their chip dominance right now. You're buying it because Uncle Sam is the largest shareholder. It's a political trade disguised as a tech trade.
And speaking of safety nets, Procter & Gamble.
The ultimate staples bunker. Get this, P&G actually missed on revenue. Normally that gets you punished.
Right, but the stock held a 2.3% gain. Why?
The dividend. They hiked it by 30%.
30%. That's enormous for a company that size.
It's a beacon of safety in this environment. Money is hiding in that staples bunker. Investors are basically saying, I don't care about the revenue miss, just pay me to wait this out.
So we have GE getting punished for guidance, Intel getting saved by the government, and P&G getting bought for its dividend. It really feels like a stock picker's market right now.
It absolutely is. The tide is not lifting every boat anymore. You have to be in the right boat. You can't just buy the index and go to sleep.
Okay, let's look ahead to Friday. We've got the flash PMI tomorrow morning. What is the setup?
The event risk is real. If that flash PMI comes in hot, especially in the services sector, you can pretty much kiss the March rate cut goodbye. It's officially off the table.
And the market would not like that.
No, that would spike yields and probably hit the NASDAQ pretty hard. But structurally, just looking at positioning for tomorrow, we are entering what's called a long gamma regime.
Okay, we explained Vanna. Now explain long gamma for tomorrow's open. What does that mean for the price action?
Think of long gamma like a dampener, or like you're driving through thick mud. When the market is long gamma, dealers are positioned in a way where they sell rips and they buy dips. It compresses volatility.
So it stabilizes the price.
It creates a magnetic effect. The market gets sticky. It doesn't want to move 2% in either direction. It just wants to pin to a certain level.
So what's the trade? If the market is stuck in mud, how do you make money off that?
We are calling it the magnetic pin long. And the trigger is any 15-minute consolidation above 6,920.
6,920. That's the line in the sand. Why that specific number?
That is the structural pivot where the dealer positioning flips. As long as the S&P holds above 6,920, dealers are supporting the market. They are buying the dips. So you want to be long SPY or SPX.
With the target of what?
The 7,000 call wall.
That 7,000 level is going to be a tough nut to crack, though.
It is massive resistance. There is so much open interest there, so many call options stacked up, that it acts like a gravity well. The market gets pulled toward it, but breaking through is incredibly hard because everyone sells when we get there. So the trade is to ride that magnetic pull from 6,920 up towards 7,000.
And if we break 6,920?
If we break below it, and I mean a sustained break, not just a wick, the thesis is invalid, we enter a gamma flip. The mud disappears, the ice appears, and we could slide to 6,900 very quickly.
Any individual names to watch for tomorrow? Any day two plays?
Two stand out. First, Meta. It closed up 5.44% today. We are looking for a break of Thursday's high, which is $646.31.
And why Meta specifically?
It's a pure momentum continuation play. That move today was on big volume, driven by that AI data center news. When a stock that big moves 5%, it usually has follow-through. It attracts attention.
Algos will chase it.
If it clears $646.31, the algos will chase it hard. And the second one is AMD. It's riding the tailwinds from TSMC's record results, and it's forming a high tight flag.
A high tide flag sounds bullish.
It is. It basically means the stock shot up and is now refusing to go down, just moving sideways tight against the highs. It's coiling. We're looking for a breakout toward that $270 analyst target.
The high beta alternative to NVIDIA.
Exactly. If NVIDIA is too crowded, traders are rotating into AMD.
So the final directive. Watch 6,920 on the S&P. Watch $646.31 on Meta. And I assume we're still keeping an eye on the bond market.
That is the final warning. If the 10-year yield stays above 4.2%, all of these gains are on borrowed time. That yield is the kryptonite for this valuation expansion. You can ignore it for a day, maybe two, but you can't ignore it forever.
Markets are closed. Go home.